Hey everybody, welcome back to the channel. We are back in another episode of the Daily Recap. It is Monday. We are starting off the week. Ironically, we had some stuff happen on Friday that we did not get a chance to talk about that I thought would have some more implications than it did today on the equity markets on Monday. I'm talking about the Moodys downgrade. We'll get more into that. But the markets were not in a bad mood, even because of Moody's. We got a downgrade on our credit rating in the United States. Not the best thing. Stocks were down badly after hours on Friday. Today, the market said, you know what? We don't care. So we'll talk about Moody's. Palantir, $218 million contract. This one went under the radar. We'll talk about that. Grok now on Microsoft. We will talk about the hyperscalers embracing new large language models. Nvidia had this massive event in Taiwan that happened literally last night. And so we'll talk about the implications of that and some more macro data. Lot to get into. Thank you, everybody, for being here. Monday. Let's get into it. Okay, so let's start off with Moody's. This was the big topic of discussion on Friday on the market close. I think I was live at 4:30-ish, and that's when the news broke. Incredible week that we had last week for the equity markets, and then a lot of that got taken away from the Moody's downgrade. What is Moody's? For those that don't know, I want to give a little bit of a recap and then talk about the implications of it. TLDR, the implications are that it's really a nothing burger. What is Moody's? Credit rating agency. They're a public stock. MCO is the ticker symbol. And them, Standard & Poor's, and Fitch are kind of the main three credit rating agencies in the United States, or not even in the United States, but globally, that kind of determine whose credit should you be buying, aka whose bond, whose debt should you be buying in a market. If you're a bond market investor, you pay a lot of money for that research to be able to figure out, hey, should I be buying U.S. debt? Should I be buying Japanese debt, or Saudi Arabian debt, or a Canadian debt, Danish debt? What is the best debt in the world to buy? Our debt has been lowered from a AAA rating to an AA1 rating, which is a tier below AAA, from Moody's. And as soon as this news came out on Friday, the market was really upset because the credit rating of the United States has now been downgraded, which means countries like Canada, Australia, and Denmark have a higher credit rating than the United States. Why does this not matter, and why do the markets not really care? The S&P 500 ended at 594 on the day, so it ended green on the day after going to, I think, 587 on Friday after hours when that news broke. Some stocks were still red on the day. Palantir was down about 2.5%. Nvidia recovered to 135. Robinhood at 64.23. We do have some news on Robinhood that we'll talk about as well. That was up 4% on the day. But why was the S&P 500 basically flat at 594.75 on the day, but recovered from the lows on Friday? I think there's a couple of reasons. Number one, Moody's downgraded the United States debt back in 2011. Markets have gone up since 2011. Our debt has, although increased since 2011, there's always been a bidder to buy our debt. So like we've been able to navigate the debt situation in crisis as well. And technology and innovation, America has been at the forefront of that since 2011 with all the technology companies, Nvidia, Palantir, Tesla, et cetera, that have done phenomenally well. So if Moody's was the reason you got out of the markets, right? Because we're investors. If you got out of the market in 2011 because of Moody's, you just like missed out on astronomical gains, especially in the NASDAQ index. If you got out of technology, you unless you put the money in Bitcoin, gold has not outperformed, real estate has not outperformed. I don't know what has outperformed other than Bitcoin. So like realistically, I think Moody's is not a reason to get rid of your stocks. Number two, Moody's upgraded the mortgage-backed securities in 2008 that went under. 2008, not a good time for the markets, worst financial crisis since 1929. They rated them as AAA. So they rated the mortgage-backed security bonds as AAA, meaning if you believed in Moody's research, and in fact, they were fined $864 million for doing this a couple years later because, that was just not a good thing to put out there into the world and convince investors that these were okay to buy. If you believed in them and you bought them, you lost a lot of money, right? You lost a lot of money as those mortgage-backed securities went to zero. So from that perspective, it's hard to take Moody's seriously when in 2011, they rated the United States down and the United States has been fine. It's hard to take them seriously when they rated in 2008 mortgage-backed securities to be these AAA bonds that you could buy. And like that obviously went to nothing. And it's also really hard to take them seriously in the context of why now? Why is Moody's right now downgrading the credit rating of the United States? We saw that Fitch did this in August of 2023. Then we bottomed the markets in October. And then we went on to have a bull market in 2024. I think that could happen again, even though I do think there's a little bit more of a macro nuance that would not really create a bottoming event, given we just had the April lows for the tariffs that would be replicated again by Moody's. But the point is, why did Moody's not do this in 2023 with Fitch? Why did they not do this in 2022? Why didn't they do it in 2021? Like we were spending like drunken sailors in 2021, in 2022. Inflation was at 10% in the United States. Why was our credit rating so good back then, or at least not good enough to go lower? or good enough to not go lower versus getting lower now. Now, one argument that, so what I'm trying to say here is there might be something political here. I'm not trying to imply that there's something political, but it makes you wonder why after the first 100 days of the Trump administration and not in the last 100 days of the Biden administration. Now, one could argue that the deficit spending of the United States, which is what the tax bill that is being proposed right now and going through Congress, will explode via the trillions of dollars of tax cuts and would add a couple of trillion to the deficit over the next decade. That in and of itself is what's getting the bond market to be upset. That's why yields are rising. That's also why Moody's is finally being like, you know what? You have to downgrade U.S. debt. Again, my answer to that is two things. Number one, where else are you going to go? Like, really? Buying Japanese debt, Canadian debt? That's better than buying American debt. America has the best military. The dollar is the reserve currency. Like, it's really hard to get me to believe that America's debt is way worse than some other country's debt, especially when that debt is not backed by what America has it to back by, which is our military. So from that perspective, it's kind of weird. And then number two, and this is basically what Scott Bessent said over the weekend on the interviews, we are going to have to grow our GDP faster than our debt. And I know no one hates, or everyone hates hearing that as like the solution to the problem. I hate hearing that as well. I want to have spending cuts. But then you realistically look at what we could be cutting in terms of spend. It's Social Security or Medicare. And we're not cutting either of those things. Maybe some welfare benefits, but we're not going to meaningfully cut those. So then, and then you have the defense budget, which I don't know if we need to spend $1 trillion like Trump wants to spend on defense, but like you're not going to get a politically popular vote from the United States to say we should spend less on keeping us safe. So if we're not going to be cutting from defense, we're not cutting from Social Security, we're not cutting from Medicare, the only solution, I'm just trying to be practical here, none of my political beliefs, just like practically, how do we resolve our debt to GDP? We've got to grow. And we've got to grow as fast as we can. And we've got to unleash growth in the United States. That's good for equity investors. That's good for people that are invested in stocks that can grow. It might not be good for our kids that inevitably have to deal with this. And I hate that as well, because I intend to have kids one day. I don't want to leave them with this type of debt. But I don't know what the solution is outside of that. Maybe Bitcoin is the solution. That's why Bitcoin's at 105,000 right now. But outside of that, if that's the only way we can grow, I don't understand why the Moody's downgrade has any meaningful implication. And I think that's what Scott Bessent basically said this weekend as well. Here's a couple clips from Scott Bessent talking about this Moody's downgrade. My TLDR is that it's a nothing burger. The market brushed it off today. Investing in the best companies in the world probably matters more than the credit rating of the United States.
I think that Moody's is a lagging indicator. I think that's what everyone thinks of credit agencies. Larry Summers and I don't agree on everything, but he said that when they downgraded the U.S. in 2011. So it's a lagging indicator. And just like Sean Duffy said with our air traffic control system, we didn't get here in the past 100 days. It's the Biden administration and the spending that we have seen over the past 4 years. We inherited 6.7% deficit to GDP, the highest when we weren't in a recession, not in a war, and we are determined to bring the spending down and grow the economy. And if we go back to your initial question on the Moody's downgrade, who cares? Qatar doesn't, Saudi doesn't, UAE doesn't. They're all pushing money in. They've made 10-year investment plans. So this administration, we're doing peace deals, trade deals, and tax deals.
Okay, next topic is Palantir got a $218 million contract, which is not too bad. Exciting stuff. So what did this contract entail? The U.S. Space Systems Commands and the U.S. Space Force, USSF and SSC, are advancing their Space C2 data platform to provide enterprise data storage and data management solutions, including seamless, synchronized, multi-domain warfighting to space and air operational communities. The award of the contract is going to be $217.8 million going to Palantir. How many years is this contract? I don't know. I talked to a couple of people today. They don't know either. I think it's about 2 to 5 years. We don't have any confirmation on that. Hopefully we'll get confirmation soon. But it goes to show a couple things. Number one, the government business continues to accelerate. We grew 45% U.S. government last quarter. I think that's going to accelerate to 50% by the end of the year. The government business is growing, and it's growing rapidly, which is another reason why I think the United States, or why the stock market is getting so excited about the United States business when it comes to Palantir, not just from a commercial perspective, but also from a government perspective. Number two, there's not a lot of other companies that are able to actually get these types of contracts. And this is very similar to what a lot of the videos I was making in 2022 were talking about, which is that government revenue is sticky. Government revenue doesn't go away. Government revenue opens up the door for new contracts, and government revenue is very confidential, aka they trust you with the data when they give you $218 million to work with the data. And as long as you don't violate that trust, which Palantir, it has IL level 6 security clearance, one of 4 companies in the world that has it, they're probably not going to do a bad job with the data because they've been working with the government for the past 10 years. So from that perspective, big win for Palantir, another 218 million bucks. I found this tweet. Chad responded to my tweet. Shout out to Chad, employee at Palantir, talking about the contract. And he was like, this is exactly what he said. He said, from mud to space and everything in between. And then I found a tweet from May 8th, 2023, almost 2 years ago to the day, that said, LOL, Alex Karp just answered an analyst by saying, our goal for AI is to just take the whole market. We have no pricing strategy. And it's kind of cool because that's kind of what's happened. Like, they have quite literally begun to take the market. They didn't need to have a pricing strategy if you didn't buy Palantir at 17 bucks at the time because you were afraid of their pricing strategy. Like, that just wasn't the, best argument to be against Palantir. It's like, no, you have to believe Karp saying we're going to take over the market. And boy, did they take over the market. And they still only have 700 customers. So like, this is a company that could 10x their customer base, hopefully 10x their revenues as well as a result of that. And, 20x their net income and their profitability in the span of being able to actually take the market. So 217 million for Palantir, great contract. Government business continues to grow. And we will hopefully try to get even more contracts in the future as they accelerate that 45% year-over-year government growth in the United States. All right, next topic is on Grok and Microsoft. So this is really cool. I'm going to show a little bit of a clip of Elon Musk talking to Satya Nadella. Satya Nadella, the CEO of Microsoft. Elon Musk, the founder and CEO of XAI, Tesla, SpaceX, Neuralink, etc. Essentially, Grok is now getting good enough to the point where it can come to the enterprise. And what's really important about this is that the models are only getting better and better and better. We're going to be seeing them in our day-to-day lives, how good the models are getting. The models are getting good enough to the point where robots might start becoming a reality in terms of physical AI. The models are getting so good to the point where my Tesla literally drives me everywhere, and there's very few interventions. By the way, I'm going to Boston. Link in the description for anyone who wants to sign up to Boston. We have the date, the time, location, everything set up. So if you sign up, I'll send an email with all the information. I'm FSDing to Boston, from New Jersey to Boston. I'm very excited for 5 hours to see kind of how this plays out. All of these models need Nvidia chips to continue their pursuit of AGI. Bullish Nvidia. All of the models need to work with hyperscalers like Google, Amazon, and Microsoft to be implemented into the enterprise. Bullish Google, Amazon, and Microsoft. And then all the models need an application layer, aka a Palantir, an ontology layer, to make sense of the data and the AI compute workloads, and then the analytical framework to be able to actually make decisions based on that data. That's where you get your MongoDBs, your Salesforces, your Datadogs, your Palantirs. I just think Palantir is one of the best ones. But you put all those software players in the middle of that stack. That is where this market is going. You got the models, you got the hyperscalers, and then you have the application layers. What Jensen is doing with Nvidia, that we'll talk about in a little bit, and what Satya is doing with Microsoft at the intersection of what Elon's doing with Grok is all simultaneous. Elon needs to buy Nvidia chips to build out Grok. Microsoft needs models to serve to their enterprise clients, and Elon needs distribution from a Microsoft to be able to get enterprise clients to use Grok, because that's how Grok makes money based on their API calls. Big tech, my point here, is still cheaper than Walmart and Costco, yet they have better margins, better cash flows, and they have massively better balance sheets that are able to support massive share buybacks. I mean, take a listen to this stat. Amazon trades at a 33 PE, Walmart trades at a 42 PE. Walmart has 2.5% adjusted operating margins. Amazon has 11.8%. Amazon grew their sales by 8%. Walmart grew their sales by 3%. Like, what is the disconnect that's going on in Wall Street? I have no idea why Walmart's getting a premium compared to Amazon. But the point is, these models are getting better and better and better, stronger than ever. In fact, there's an AI startup called, let me pull it up right here. I talked about this on the market close today. There's an AI startup called genspark.ai. You guys can check them out if you want, genspark.ai. In 45 days, these guys have done $36 million in annual recurring revenue. Part of the reason that Palantir is getting their multiple, part of the reason why investors are putting $300 billion of evaluation into OpenAI and ChatGPT is likely because you've got all these startups in the AI space that are growing faster than anything we've ever seen. Cursor AI, they've now hit $300 million in annual recurring revenue. They're basically a vibe coding AI assistant that helps you code. So kind of the idea that if you're a coder, you can code even better with AI or potentially get replaced by AI. That thing is growing, and it's the fastest growing startup to ever hit $100 million in annual recurring revenue. I think the street is expecting this marketplace of AI to accelerate the total addressable market in so many different verticals by a factor of not 10x, but maybe 100x. And as a result, could Palantir legitimately grow 40% for the next 10 years? I don't know, but the market's acting like they can. And when I see startups genspark.ai is basically a replacement for Microsoft Excel, and you put in all your data and it gives you all these insights, yada, yada. I'll put a video in the description if anyone wants to check it out. Like, when you really think of it, it should be able to, like, Microsoft should be able to do what they're doing. Amazon should be able to do what they're doing. Palantir should be able to do what they're doing. The fact that these little startups are still able to find a marketplace for themselves, even if you think of them as a GPT wrapper, is incredible. And I think that shows the sophistication of this technology when it comes to AI, how rapidly it is being deployed and adopted by all these different enterprise clients. And as a result, Grok, OpenAI, Anthropic, Gemini, there's just a lot of momentum in regard to the models and the implementation of those models as well. I think the takeaway is bullish big tech. Here's a little clip of Nadella and Elon talking today at the Microsoft conference.
It's a family of models that are both response and reasoning models, and you have a very exciting roadmap. You want to just tell us a little bit about sort of your vision, the capability. You're pushing on both capability and efficiency, so maybe you can just talk about a little bit of that.
Sure. So yeah, with Grok, especially with Grok 3.5 that is about to be released, it's trying to reason from first principles. So apply kind of the tools of physics to thinking. So if you're trying to get to fundamental truths, you boil things down to the axiomatic elements that are most likely to be correct, and then you reason up from there, and then you can test your conclusions against those axiomatic elements. And in physics, if you violate conservation of energy or momentum, then you're either going to get a Nobel Prize or you're wrong, and you're most certainly wrong, basically. So, that's really the focus of Grok 3.5 is sort of fundamentals of physics and applying physics tools across all lines of reasoning, and to aspire to truth with minimal error. Like, there's always going to be some mistakes that are made, but we aim to get to truth with acknowledged error, but minimize that error over time. And I think that's actually extremely important for AI safety. So I've thought a lot for a long time about AI safety, and my ultimate conclusion is the old maxim that honesty is the best policy.
All right, next up is Nvidia. Nvidia had an event last night in Taiwan that I thought was actually very interesting. I did not stay up to watch it, but they announced a bunch of things that were really important. We had Jose on the Market Open to kind of talk more in depth about what they announced. The biggest thing that I got from what Nvidia did, and this is also what Jose was able to talk about today, is their NV Fusion Link technology platform. Now, what is this? Nvidia unveiled NV Fusion Link, a new silicon offering in their chips that allows the integration of Nvidia chips with non-Nvidia chips, for example, ASICs, to build semi-custom rack-scale AI infrastructure for hyperscalers, enabling chip-to-chip communication for AI systems. What does this mean in layman's terms? It means NVIDIA is not slowing down. And what the implication of that is that GCP, Amazon, Microsoft, all of these hyperscalers, Meta, the thought was, in terms of the bear case for NVIDIA in 2024, they're going to build their own chips. There was a Bloomberg headline that Amazon is building their own chips, their own Trainium chips, and they're going to commoditize NVIDIA's chips, and they're not going to have to buy NVIDIA's chips. 45% of NVIDIA's revenue is from the hyperscalers. So if Amazon and Microsoft and Google are building their own chips and they don't need NVIDIA, that's not good for NVIDIA, right? The bull case for NVIDIA is gone. First of all, they were never going to build like Blackwell or Hopper, Rubin, right? So when it comes to the most advanced types of chips, the hyperscalers are like making some progress, but they're not replicating what NVIDIA has done, right? So that in and of itself, as a bear case, was never that exciting to kind of hang your head on as a bear. But the threat of the chips being commoditized, based on what NVIDIA announced yesterday with NVLink Fusion, is essentially saying, hey, GCP, you have your own TPUs that you've been working a decade to be able to build, your own chips. You don't need to completely get rid of that technology to enhance, to transfer over to NVIDIA chips in certain parts of your business, which is kind of what has been the case over the past year. We have built a technology, NVLink Fusion, that can connect our chips to your chips so that they can communicate with each other via these special silicon offerings that integrates the racks of your chips and our chips, and now they can work simultaneously with each other. In a nutshell, that's the biggest thing that Jensen talked about yesterday. They also confirmed that GB300 is on pace for launch in Q3 of 2025. Now, why does that matter? That doesn't mean that NVIDIA is going to get unlimited sales from Google, because now Google is just going to keep buying NVIDIA chips because they don't need to replace them with their TPUs. But that does mean if there was any risk that Google was going to replace Nvidia with their TPUs over the next 5 years, that risk has been heavily mitigated. Because although it doesn't mean Google is going to buy 100,000 Nvidia chips, if they're still going to buy 50,000 chips versus 0 chips, that means the growth story for Nvidia can continue, even if that growth story is not going to put up 70% growth numbers, which again, the street's not expecting 70% for the next 10 years. They expect it to plateau at some point, but they don't want it to go from 70% to 5%, which has happened in previous cycles with Nvidia when it came to gaming and when it came to crypto in 2021 with Bitcoin miners. So Nvidia has had peaks and valleys in regards to demand. That's why everyone is so afraid of it from a cyclical perspective. But if you believe in the broad scale nature of what Nvidia is doing and what they announced yesterday, I don't think the market is fully understanding it. I don't even fully understand it. But from everything I've been reading today, if they're able to convince the hyperscalers to keep buying their chips to be able to build the integrated technology for each of their chips to communicate with each other, the hyperscaler custom chips versus the Nvidia chips together, it can get very, very exciting for the overall Nvidia story. And that's why I think yesterday was very important. Another thing that was important is Taiwan is now going to be the geography with a new Nvidia headquarters. It's called Constellation. Nvidia is opening it up in Taiwan. Why are they doing this? I don't really know. My conspiracy theory here is that Trump told Jensen he will repeal the AI diffusion law, which will allow Nvidia to sell millions of chips into the Middle East if, it's my conspiracy, if Nvidia opens up a headquarters in Taiwan. Maybe to potentially be some type of an invisible wall that stops China from invading, because now if China invades Taiwan, they're also invading Nvidia. China put out this statement today that they're really upset that the United States export controls are as aggressive as they are right now, specifically on AI chips. China obviously wants to buy Nvidia chips. I think President Trump is using Nvidia as a bargaining tactic to be able to get the deal that he wants, and eventually Nvidia will be able to sell those chips. But man, oh man, would that be a hell of a move if the reason for the Taiwan HQ is to essentially stop China from invading into Taiwan. Again, that's my conspiracy. I still don't know why they opened up a new headquarters in Taiwan. I mean, probably because they use a lot of TSMC chips and they need a integrated location to be able to magnify the returns and the types of work that they're doing. And in Taiwan, that makes the most sense. TSM's revenue, by the way, they guided $3 billion more than what the market expected. Their April sales were up 60% year over year. Taiwan semiconductors demand is incredible. But it does make you think, why did Nvidia integrate a new headquarters in Taiwan? All right, final 2 updates for the day. Robinhood. Why was Robinhood up 4% on the day? Well, it looks like Robinhood, I don't really have a reason why Robinhood's up. Maybe it's because of Bitcoin. By the way, the reason I think Bitcoin is up is because if the deficit is going to explode and the money printer is going to be turned on in 2 scenarios, that is bullish for Bitcoin. So a couple things on Bitcoin real quick. Bitcoin got $6.5 billion in AUM. The ETFs brought in over the past month. So huge institutional money coming into the asset, which is very good for Bitcoin. Number 2, if we're going to keep debasing our currency by increasing the deficit and increasing our national debt, which is what this tax bill is going to do inevitably, you buy Bitcoin, right, as a hedge against the debasement of that fiat currency. Number 3, if no one's going to buy our debt because bond yields keep going higher, they were at 4.6 today. At one point now they're back at 4.4, so it's a little bit more chill. The Fed's going to have to turn on the money printer and buy our bonds. We have not had a bond auction fail yet. If that does happen, then we've got an issue. But all 3 of those scenarios are bullish Bitcoin. Either Fed turns on the money printer, either we keep debasing our currency, or institutional capital continues coming into the product, which is what we've seen with the ETFs. And as a result, all of that continues to get Bitcoin some momentum. By the way, MicroStrategy, Saylor bought another 7,300 Bitcoin this morning as well. Now, Bitcoin going up is good for Hoodie. The only reason I think Robinhood is up today or getting that 4% move, because usually it moves with the market, moves with Bitcoin. Bitcoin was up a little bit today, but Robinhood getting that alpha compared to what happened with Bitcoin, to me, didn't make a lot of sense. The only reason I have for why Bitcoin, or for why Robinhood was moving today, is a 9-page essay that Robinhood officially submitted to the SEC. It's a letter advocating for real-world asset tokenization, RWA. Their key asks are federal regulatory frameworks for tokenization, letting broker-dealers freely custody and trade tokenized assets, treating tokens like underlying assets, and 24/7 trading with instant settlement for the tokenization of any asset class globally. Bullish. I mean, I thought Robinhood was years away from tokenizing assets. It looks like they're months away. Paul Atkins, the head of the SEC, if he is able to grant Robinhood what they need from this administration, not being as dogmatic as Gary Gensler was in the Biden administration, then we might be able to trade Apple on the blockchain, whether it's Solana, Ethereum, whatever blockchain Robinhood uses, quicker than I thought. We might be able to trade Manhattan real estate on the blockchain. We might be able to trade SpaceX on the blockchain. If Robinhood pulls off what Vlad has been talking about for the past 7 months now, and they do it in the next year, I think the stock is not going to be where it's at right now. $64 on the day, up 4%. Congrats to all Robinhood longs, but very, very exciting for Robinhood. Ultimately, tokenization seems like it's coming sooner than what we thought. All right, final update on the day, Mr. Tom Lee. What did Tom Lee say? Well, he's bullish. Tom Lee said the following things today in his interview on CNBC. Number one, he said the bond market already priced in what Moodys said on Friday. It's not something that the credit markets may be as concerned about, basically saying, hey, no one cares about Moodys. The market already knew about it. Number two, he says the real signal for a credit crisis is if a bond auction fails. We haven't seen that yet. Could happen in the future. Hasn't happened yet. There's still a bidder for our bond because people want to buy American debt. So no signal for a real credit crisis yet. Number three, he says our institutional clients are still skeptical. We think there will be significant chasing of the rally into the year end. I really like hearing that because if the big guys are still skeptical of this rally, bullish, that means that there's probably more money coming on the way into chasing this rally. And that could kind of affirm Tom Lee's thesis right here that big money still is on the sidelines. We know that there's $7 trillion on the sidelines on money market funds. That could be obviously very important for the broader markets. And then he said, I think the Max 7 will hit their all-time highs later this year and are still undervalued, which based on the analysis I did on Walmart and Amazon in this episode, I agree. I think the Max 7 are stupid cheap. Google has their I.O. event tomorrow. I'll be streaming that on the channel. Hopefully Sundar can kind of change the AI narrative, but I think the Max 7 are not that hard to be buying at these levels, even though they've rallied heavily, so they could have a pullback, obviously, but it's the Max 7. These are the best companies in the world. And then finally, he said the UMISH consumer sentiment survey showed a massive divergence between reality and expectations. If the hard data doesn't catch up to the surveys, the consumer will continue to remain strong. We didn't talk about this because there was no daily recap on Friday, but the UMISH consumer sentiment survey surveyed 200 people out of 330 million Americans. A little weird. And then number two, the people in the survey, which from a lot of studies I've seen lean a little bit more to the Democratic side of the party, estimate that inflation will be 7% at this time next year. I don't know who thinks inflation is going to triple, more than triple over the next 12 months, especially given the CPI, PPI data we've seen. I don't think the tariffs are going to be that inflationary to the point where we get back to June of 2022 levels. But nonetheless, if the Fed looks at the UMISH consumer sentiment survey as the basis on making a decision, then this Fed is never going to cut rates. And I just hope that the Fed realizes that maybe the data is a bit skewed. Maybe 200 people is not a big enough of a sample size. And maybe there's a lot more people in the country that believe that inflation is actually coming down and that it would be better to cut rates. And in fact, cutting rates would actually unlock different ways for inflation to come down, for example, the housing market, versus being obsessed about what's going on with the tariffs. I'm not saying there's not an upside risk to inflation. I'm just saying 7% is likely not going to happen. All right, that's it for me. Thank everybody for listening and watching. This is the first daily recap of the week. We got a big week coming up. We got a lot of different things going on, especially in the context of Google's I.O. event. I will be streaming that tomorrow. And we will continue to cover the markets as we do every single day. Boston meetup happening on Friday or Saturday. Very excited for it. FSDing on Friday. I will be documenting that journey from New Jersey to Boston. First FSD 5-hour drive I've done. So I will let you guys know how that goes as well. Thank everybody for listening and watching. I'll see you guys in the next one.